Kashkari today. There's almost no, quote, almost no evidence that inflation has peaked. With all due respect to the Minneapolis Fed president, where's he looking? I mean, the JOLTS numbers suggest that the labor market is coming back into balance. Container costs, Josh talks about that, way down. Gas is way down. Lumber's way down. Housing prices are down. Rent inflation is on its way to peaking. Used car prices are down. Chicken's down. I know inventories are up. Clothing prices are going to be coming down because there's a lot of inventory that's going to be cut in price. And on and on and on and on and on.
Yeah, I don't think Kashkar is necessarily right about that, especially given the litany of data you just laid out. My best guess is he's looking most specifically at the PCE price index, which did show the core still being stubborn and not peaking in that regard, the core PCE, less food and energy. But I think you have to sort of go beyond that and say, well, what is he saying for policy there? He says he's no evidence inflation has peaked, and he's not comfortable pausing until he sees that evidence that inflation is cooling. Indeed, I think that the question becomes, if I had a chance to ask Kashkari what he's looking at, and also, Scott, I don't know if you want to talk about this yet, but Bostic also saying these are early days.
Still in the early days. Fight. What? I mean, still in the early days. Yeah. What? I mean, they've done 3 75 basis point hikes. How are these the early days?
Well, I guess in terms of the total amount of decline in inflation we've had and how much they think needs to be done. Look, Scott, I think the key is that they have their eye on this level. And this level, Bostic lays it out 4.5%. The median forecast for a Fed official is 4.6%. And I think when they say these early days, they're saying, look, this is where we're going. We're going into a restrictive territory, and we're going there. I think Josh was talking about this irregardless of almost irregardless what happens with the unemployment rate or the economy. Here's a quote from Bostic from his speech yesterday I think is worth pointing out. If economic conditions weaken appreciably, for example, if unemployment rises uncomfortably, it will be important to resist the temptation to react by reversing our policy course prematurely. And, of course, Scott, that follows my questioning to Loretta Mester, the Cleveland Fed president, last week, where I said, if there's a recession, do you stop? And she basically said no.
Right. I mean, Bostic, he talks about getting to that level and then holding. I want you to listen, Steve, to Eric Johnston of Cantor Fitzgerald, who was decidedly negative on the market and then came on Overtime a couple of days ago and was a different person completely. And I want you to listen to one of the principal reasons of why he has changed his view, and I want you to react to it on the other side. Eric Johnston, let's listen.
We're very bullish, and our conviction is very high. We think the Fed's last hike is going to be December 14th. So we're a mere 2 months away from this Fed hike cycle being over. And then the capitulation indicators have all shown up in the last 10 days, where you had the VIX hit 34. You've had the VIX curve invert. You've had the RSI go well below 30, and a number of others that all suggest that we are going to have a sharp bounce.
So I'll let my stock people, get in on the market stuff. But what about the Fed stuff at the top? Yeah. December's it. December, they're going to do it, and then they're going to wait. What do you think?
Yeah, I was going to say, let your terrific committee there speak about the probabilities or the bullishness around that comment. But I'll say that's not a crazy idea. And interestingly enough, Bostic sort of mentioned it. You remember I asked Powell about the possibility of a pause. He said now is not the time. It could be. Look, what Bostic said today is he wants to get to the 4.5% range. Worth looking at this point, guys in the back, perhaps at the Fed rate outlook right now, which shows, I think, a 4.27 number on the year-end rate, and then it goes to 4.54. I think that 4.54 is probably not a given. Weiss was talking earlier about there's no chance at all of there being a 50 in November. He's sort of right about that. I just would point out mathematically there's a 17% chance of a 50, but it is 86 or 83% the other way. That, of course, is splitting hairs. And then they have a 50 built in with an 80% probability of a 50 for the December meeting. And then maybe there is an argument for a pause to see what effect they've had. There's a lot of folks you talk to, especially in the real estate market, the commercial real estate market, the residential real estate market, that say, look, there's going to be some trouble out there. I talked to Rick Reeder earlier today, and I asked him about illiquidity in the bond market. And I said, Rick, if a 10 on the Richter scale is 2008, the financial crisis, and March 2020, the pandemic. I said, what is it today? He says it's about a 6. In terms of illiquidity in the market. So it's something worth noting. He says some days you can place your paper and do just fine. Other days there's illiquidity in certain parts of the market. So maybe worth having Rick on again with you guys. But we are monitoring this illiquidity thing, not ready to ring the alarm bells on it. But you got to listen to it. What you really don't want to have happen is something break like happened in England. England may not be out of it. Who knows if they're going to be able to stop buying bonds next week to save the pension funds there. And that's the kind of thing, maybe that's a black swan event you got to worry about over here that could certainly stop the Fed. I don't think he's crazy. I mean, maybe Johnson's off by 3 months and maybe 0.5 point. But I think this 4 to 4.5% range is something worth monitoring. When they get there, I expect the Fed to go sort of flat, not raise anymore, and then hope that inflation comes down underneath that consistent rate, because I think it'll be a while before the Fed reverses course.
So, Bryn, then 75 in November, and let's just assume that then it's 50 in December, whatever it is, and then they do make the case that, okay, that's a lot, right? I mean, we rattle off 75 here, 75 there, 75 everywhere, as if it's an insignificant number at this point. It's already unprecedented to the point of you've done 3 huge ones in a row, and you are likely going to do another 75, which shouldn't be understated in any way, shape, or form. But if they suggest that, is Johnston right? If they make it clear, or we get the idea that December is it, is that reason why stocks are going to take off ahead of that? They're not going to wait for word.
So Fed funds right now, what, 3.25? So if we got a 75 and 25 or 50-50, however you want to slice it, that puts you at 4.25 by the end of the year. We're already in this uncharted water where the Fed has done the fastest rate hike from 0 to 4.25, if that's where we get. That percentage change has never happened before. And so I agree with Eric if that does occur, which it should occur, because they do need to wait and pause because they all know about the lag effect. I think if they continue to raise rates after December, that would be incredibly irresponsible. Because the reality is what they're doing, they can't control energy. They can't print energy. They can't do a lot of things with raising rates. And I think that they will stop. They will take note. But what's important, though, to Eric's thesis is what does the economy look like once we get to December? So I would wait and see. I still don't think we're going to have this V-shaped rally back up to the highs or even close to that. I think we're going to have a ton of chop, but another 1% rate hike is all we could handle if we can even handle that much.
See, Steve, are they influenced?
Hey guys,
hold on real quick, Josh. Hold on real quick. I'll come back to you.
Okay.
Steve, are they influenced by what's happened overseas? Do you think that's crept into the room a little bit of uncertainty? I go to the Rick Reader 6 out of 10. I mean, you don't want to get to 8 or 9. Then it's past the point of return. If you've already broken it, you can't glue it back together all the time. It's harder to do that. It doesn't look the same. It doesn't feel the same, right?
You're right. And then what about Scott, the impression that it gives that the Fed has to reverse course because it broke the bond markets? I mean, that's a real institutional issue for them. All I can say, Scott, is for sure they're watching overseas. I guess they are. I know they're communicating with their overseas colleagues over there, the head of central banks. I do know also that they are monitoring U.S. markets on a consistent basis. Let me just say one thing that was to the last comment that was made, which is the Fed might stop to look around because it's not sure how its rate hikes will play out in the economy. Just to stay the hand of the bulls for a moment here, I know that mixes a metaphor, but anyway, to stay the hand, Scott, you also don't know what's going to happen. You don't know how all these rate hikes are going to work through the economy. So I would say be very careful. I wouldn't say it's a green light. Perhaps it's a yellow light where there was a red, where you also want to be careful about how these Fed rate hikes play out in the economy because there could be damage that's not immediately apparent.
Well, I can guarantee you this. This is not going to have a stimulating effect on the economy. That's for sure. Josh Brown, what do you want to say?
I wanted to build on something that Bryn was saying, which I really agreed with her comments. Like, we're going to have these rips in the market, and the one that just took place was pretty notable. It was the 12th time ever that this has happened. There have only been 11 other instances, but we had back-to-back gains of 2.5% for the S&P 500. It's pretty rare to happen beneath the 200-day moving average. But, like, that's the whole point. So we're going to have these rips, but, like, the market gets turned away from the 200-day all the time this year. And until that changes, I don't think there's any reason that anybody should change their mind from the current psychology. And that lower high, lower low trap that we've been in really since January 3rd is still intact. Now, what's working? It's really not a complicated market to figure out. You look at the sectors in the market where they have the highest percentage of stocks above that 200-day moving average, meaning the sectors that have the most stocks that are in a defined statistical uptrend. 80% of the energy sector is in an uptrend. So if you have to do something, like if you feel absolutely compelled to want to do something, that's like a target-rich environment. Staples is the runner-up. Only 30% of staples are in an uptrend. Only 28% of healthcare are in an uptrend. That's the market that we're in. There are stocks that could have these massive 1, 2, 3-day rallies, 20% off the lows in some cases, but they don't stick, and they're few and far between when you broaden out the charts any further, than just the last 7 days, 10 days. There are very few stocks in uptrends right now, and that is why I think these rallies are all guilty until proven innocent.
Yeah, fair point. It's hard to argue with that in any way, shape, or form. All right, let's do this. Leisman, thank you as always.